Welcome back to The Explainer. Today, we're diving into something massive. We're looking at a huge, completely hidden economic shift happening right under our noses in 2026. Let's pull back the curtain and decode what's actually going on behind the scenes of global finance. $2.5 trillion. I mean, just let that number sink in for a second. That's a 2, a 5, and 11 zeros. It's not just a big number in a vacuum. That is the actual, literal scale of the private credit wave washing over the global economy right now. We're talking about an astronomical amount of capital here, and it really sets the stage for everything we're unpacking today. So here's the central mystery we're tackling today. Why exactly is the fastest growing asset class on Wall Street quietly cracking? Because, on the surface, everything looks totally fine. But as we dig into the data, you'll see that beneath the waterline, the structural foundation is dangerously exposed. Let's figure out why. Section 1. The end of cheap debt, or, a very dangerous assumption. To really grasp what's hitting us in 2026, we have to recognize a pretty wild assumption that investors and corporate borrowers have been making for years. They basically assumed that borrowing would just stay cheap forever, that endless refinancing would always be right there waiting for them. But look at this historical shift. The 30-year Treasury just spiked to its highest levels since the 2007 global financial crisis. Think about that timeline. A market move of that magnitude, it doesn't just happen without some serious sweeping consequences. Yet, amazingly, almost nobody seems to be paying attention to it. Section 2. Sovereign bond markets. Spiking simultaneously. Now we're going a layer deeper into this economic iceberg. Because actually, this treasury spike isn't just some isolated one-off event in a single country. The data shows us that right now, 4 of the world's absolute largest sovereign bond markets are all spiking at the exact same time. It's a synchronized, compounding pressure on the entire worldwide financial system. So what's the actual macro cause and effect here? Well, rapidly rising interest rates mean that comfortable assumption of endless refinancing is getting severely challenged. When these massive sovereign bonds spike all around the world at once, global borrowing costs naturally surge right along with them. And that completely shatters the illusion of cheap debt that this entire $2.5 trillion market was built on in the first place. Section 3, the floating rate time bomb. Let's look at the trigger mechanism. Okay, now that we've got the big macro picture, we really need to see how these global interest rate spikes create a very real, very immediate danger for everyday corporate borrowers. To understand the exact trigger mechanism of this impending crisis, we have to define a crucial piece of financial jargon. It's called SOFR, the Secured Overnight Financing Rate. Put simply, this is the benchmark interest rate that dictates the cost of borrowing for dollar-denominated loans. Basically, just think of it as the baseline heartbeat for corporate borrowing costs. Back in the previous era, SOFR sat essentially at 0%. Money was virtually free, and obviously that encouraged a massive amount of borrowing. But fast forward to our current reality, SOFR has spiked to over 5%. The speed and scale at which borrowing costs have absolutely exploded for companies everywhere is just shocking. And here is where the dots really connect for the borrower. Because so many of these massive corporate loans are structured as floating rate loans, their interest rates literally float upward, right alongside that SOFR rate we just talked about. So suddenly, borrowers are staring down the barrel of massive, unpayable interest burdens. These floating rate loans have quietly turned this rate spike into a literal ticking time bomb. Section 4. Private credit and PIK. The hidden truth. All right, let's clearly define our terms here. Private credit is a rapidly expanding industry of non-bank lending directly to corporate borrowers. So instead of a highly regulated traditional bank giving a business a loan, a private investment firm steps in to do it. What this means is that this massive mountain of debt is accumulating largely out of the public eye. And if this cracks, it doesn't just stay on Wall Street, it trickles all the way down, impacting broader economic stability, jobs, and overall corporate health. And the growth of this sector is frankly staggering. During the 2007 financial crisis, this market was just a tiny fraction of its current size. Today, we are looking at nearly a 10-fold explosion in private credit. That absolute magnitude is exactly what sets up the systemic risk we're talking about today. But this begs a pretty huge question, right? If corporate borrowers suddenly can't pay their new 5% floating interest rates, why in the world haven't we seen a massive wave of bankruptcies yet? Well, the answer is PIK, or payment in kind. It's this fascinating accounting loophole that allows a borrower to pay their interest with more debt rather than actual hard cash. And this loophole, right here, is the exact mechanism keeping the crisis completely hidden from the public eye. This totally exposes the sheer absurdity of how this operates. Imagine a company that can no longer afford its new, much higher cash interest payments. Instead of defaulting, that unpaid interest is simply tacked onto the principal loan amount. They're basically just growing their overall debt. And the truly wild part? That loan is then officially recorded on the books as healthy and performing. A company could literally be sliding straight toward bankruptcy, yet on paper, everything looks perfectly fine. It's wild. Section 5, the trillion-dollar wave, our exposed system. Okay, we've looked at all the individual moving parts. Now we really need to bring all these pieces together. Cracks are absolutely beginning to appear beneath the surface of the fastest growing asset class on Wall Street. When you combine benchmark SOFR rates jumping to over 5%, the huge prevalence of floating rate loans, and then the widespread use of this Pike loophole to cover up the distress, you create an entirely unsustainable illusion of stability. There's an incredibly powerful takeaway from our source material that puts it perfectly. Interest rates have risen at the fastest paces in recent history, and moves like that don't happen without consequences. The crucial point we have to walk away with today is this. The bill for this $2.5 trillion wave of hidden compounding debt will eventually have to come due. I mean, the basic math of compounding interest simply demands it. And that leaves us with one final, deeply provocative question to wrap up today's explainer. When the Pike loophole can no longer hide this rising mountain of debt, who exactly is going to bear the brunt of the inevitable collapse? It's a fascinating, honestly kind of sobering reality that we all need to be thinking about as this financial story continues to unfold. Thank you so much for joining me to unpack all of this, and as always, keep learning,